Good morning, everybody. Dan Russo, Chief Market Strategist at Chaikin Analytics, bringing you our Stock Market Today update for Thursday, September 10th, 2020. Head over to Twitter. You can follow me there at Dan Russo _CMT. As always, Stock Market Today brought to you by Chaikin Analytics. If you head over to chaikinanalytics.com, you can sign up for a free email where I get a lot of the content for this show and also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities finished higher Wednesday following a 3-day slide that saw the NASDAQ 100 drop more than 10%. Treasuries were mostly weaker, with the curve steepening on the heels of a 10-year auction yesterday. The dollar was stronger against the yen, but weaker on the euro cross. Gold was up 60 basis points. WTI crude settled up 3.5% after the previous day's 7.5% sell-off. So a little bit of a rebound here in some of the beaten up areas of the market. Kind of interesting. Also interesting, though, as we'll look at, that SPY did not hold the key level. Across the sectors, it was discretionary tech and materials that outperformed, while energy and financials, again, were relative laggards. All were higher on the day. But as we get to the desk this morning, a little bit of a turnaround in the other direction as futures are down 50 basis points in Thursday morning trading. Back near their worst levels of the morning, Asian markets were mixed overnight. Japan and South Korea better, China and Hong Kong both ending on the downside. European markets are weaker. Treasuries are little changed overall. The dollar is weaker on the major crosses, and there's some views out there that the dollar could be resuming its downtrend. We'll have to see how that plays out. Gold is up 10 basis points. WTI crude is down 1.8%. A little bit of a different look here this morning. I think it's kind of important to pay attention to what the major averages are doing. So yes, the key chart is the S&P 500. But the key levels remain in play for all of the major markets in the U.S. So we have 3,400 on the S&P 500 or 340 on the SPY ETF. If I'm thinking about what the main level is for the Qs, we're watching 270, and then below that, the breakout level. You can see that yesterday the Qs held 270, whereas the S&P 500 could not hold 3,400. For IWM, the small caps, we're looking at 150 closely. And so we have small cap and the Qs holding their levels. S&P 500 did not. So for the S&P 500, we're still watching 3,300 to 3,400 as support, 3,250 below that. 3,500 to 3,600 is the resistance zone for now. As I said, for the Qs, the bulls want 270 to hold. For IWM, 150 is a key break point. Thus far, the averages remain bent, not broken. All right, that's the view I have right now. Individual stocks is different, right? If you have there, you've probably had to take some stops and you've probably had to manage some risk, and that's fine. Remember, individual names will move more than the averages. I mean, by definition, the averages are the averages of all of their stocks, right? So some of the individual names are going to move more. That's why risk management becomes important. And I like to use the major averages as a framework. What's the trend and how aggressive do I want to be? I think that below 3,400 on S&P 500, the odds are tilting towards the uptrend off the March low failing. Okay, not guaranteed. It's an odds game, right? So where the odds were higher 5 days ago, they're lower today. If we get back above 3,400, those odds shift. Remember, the odds shift every day. There's no one rule. There's no one magic bullet. Okay, your odds shift every day. My view could change between now and the end of the day. It can change drastically based on what happens. It's not about making the call. It's about getting on the right side of the probabilities. Now, our market in a minute, what are we writing about today in the note? Well, we got a rebound in the SPY, but it fails to retake that 340 level for SPY, 3,400 for the index. Breadth weakens over the past week, and those divergences that we've been talking about ad nauseum remain in play. Industrials are a rising sector in relative terms, and that's kind of interesting to me. We'll take a look deeper. Actually, we're going to take a good look at all of the cyclical sectors so you can see the difference and why you can't just make the blanket statement, well, I'm going to rotate into cyclicals. Growth is faltering. I'm going to rotate into cyclicals. That's not how this works. You have to do the work, folks. Saying to rotate into cyclicals is arguably one of the most lazy statements I could ever hear. And believe me, I hear it. And the people who make it are lazy. We're screening for bullish personality changes in our screen of the week this week. And futures, as I said, point to a lower open here today. Now, for the major indices from a power bar perspective, well, the Dow was up 1.6%, 10 to 2 bulls to bears. S&P 500 up nearly 2%, 148 to 69 bulls to bears. They're seeing some, it was still positive, but we've seen some deterioration. There's no doubt about it. NASDAQ up 3%, 29 to 9 bulls to bears there. Small caps add 1.5%, relative underperformer on the day. 621 to 304 bulls to bears there. Bonds downtick, sending yields higher. Tech was your rebound sector of the day yesterday, up 3.25, 3.25 for tech. Still not chasing it. 19 to 5 bulls to bears, right? The odds have changed, right? We talk about it. So the odds have changed. So if the odds of the uptrend continuing have changed, you definitely don't want to chase the most extended sector in the trend, right? It doesn't make any sense. You do want to potentially look for where there's viable reasons to believe in rotation, right? It's not energy and it's not financials, but we'll take a look at materials and industrials, the two that I've liked, the two that I've been talking about, right? It's not all in, all out, folks. It's not we were in on growth and now we're in on cyclicals. No, you can slowly rotate out of growth if that's the right call and slowly rotate into the cyclical areas that are outperforming. That's a better way to think about it. And think about what that does for your portfolio in the near term. If you were all jacked up on growth, now you're rotating and diversifying a little bit further. Let's look at our stock of the day. Stock of the day now is not a stock of the day. What is it? It is a screen, something that we've been doing here on Thursdays and now even on Tuesdays a little bit because the feedback is good. The feedback that I'm getting from people on it has been really good. So I want to continue to do that. So our screen of the day is what we're looking for here, called bullish personality changes. These are stocks that have gone from being underperformers to now they're in the early stages of outperforming. They're interesting. Chances are, for the most part, they're going to be overbought. However, let's just kind of keep an eye on stocks like this because they become interesting as potential ideas, especially if the rotation that I'm talking about, right, into those leading cyclical areas start to play out, right? If industrials are going to continue to work, well, I want to know that CAT is beginning to outperform, right? And I want to know that Emerson is beginning to outperform, right? And I want to take a look at names like Wabtec, which are beginning to outperform, and even some of these neutral names down here like ITW and Kellogg, right? Across the board. In the meantime, we're seeing a little bit of a perk up in some restaurant stocks, right? So Starbucks begins to look interesting. I will, in fairness, say Caterpillar broke out yesterday, so I did buy it. But this is an interesting screen that we like to run. These are names that have gone from being underperformers that are in the early days of potentially outperforming. I mean, look at some of the names on here: McDonald's, Disney, Costco, right? Very interesting group of stocks. And importantly, diversifies what is likely large overweights to those big cap tech names that could potentially still be in your portfolio. So that becomes really interesting. I love this screen. It's a starting point, right? You don't just run out and buy all these stocks. You don't say, hey, Dan had this screen and I bought the stock and it went down. No, do more work. Figure out what's going on. But this is an interesting screen. I like it a lot. Let's look at our sector tracker now, moving to the major sectors over the last 5 days. All sectors lower. You have utilities at the top of the list. There's your defense. Materials group that we've liked, outperforming. Real estate, defense at the top of the list. Financials are kind of interesting. I don't think they're going to sustain near the top of the list. I think rates are heading lower once again. Let's look for opportunities to sell some financials. Middle of the road, staples, industrials, healthcare, and discretionary, and then energy, comms, and tech at the bottom of the list. We all know what's going on here. We've seen the rotation. We've seen the sell-off in tech and comms. Energy is just a disaster. And there's just no reason to be involved there. Believe me, I want a reason. I want a reason to be involved because it's so under-owned that if we can get there early enough, people are going to catch on. You're going to make a lot of money in energy. The time is just not now. It may never be, but believe me, I wish it was different. Our industry in focus. Insurance services over the past 6 months been an underperformer by about 8.5%, but it does have a good power bar. So 27 to 2 bulls to bears. They're number 2 of 21 subsectors. Names like Principal, PFG, CNO, CNO, and a reinsurance group, RGA, are very bullish. The group itself is more of a mixed bag, and I would argue with a downside bias. Neutral fund, strong trend above the trend line, bad money flow, bad relative strength. So the group itself, not that interesting. So this is kind of a situation where the fund is awful, but you do have a lot of bullish stocks. So better opportunities elsewhere is kind of my view on that. Better opportunities elsewhere. Speaking broadly about insurance, better opportunities elsewhere. Are there one-off names that might start to look interesting? Sure, if you're doing your work and it helps diversify your portfolio a bit, not a bad idea. But bigger picture, better opportunities elsewhere. Let's take a look at what's happening now from a trending perspective. Yesterday's S&P 500 movers and shakers, our gainers and losers. We have Corvo, QRVO, raising their guidance, and that helped the group in general. Corvo up 7.5%. NVIDIA goes along for the ride. I will point out, those of you who are Chaikin clients or have taken the 14-day trial, on Sunday you received a note from Mark Chaikin, on Monday rather, because of the holiday. You received a note from Mark Chaikin pointing out NVIDIA as a bullish idea, so kudos to you. Skyworks goes along for the ride with the semiconductors up 5%. Align is a name that, quite honestly, I'm stalking. Up 4 3/4, and BIO. No real news there to send that stock higher by 4 3/4%. Loser side of the board, Tiffany, their deal with LVMH officially breaking. That stock down 6.5%. American Airlines, no real news on these other stocks, just kind of some fade to the reopening trade, right? Got a little bit, they've popped and now they've come off a bit. And I think source of funds is kind of how I view these groups. They're just not good and nothing I want to look at here. So AAL, CCL, UAL, nothing really to talk about there. Under Armour giving some back after their restructuring news, down 3.2%. And all I'm going to say to you is this: why would you own Under Armour when you can own Nike? Completely different companies. Look at the charts. Look at Under Armour. Look at Nike. Look at Lulu. Even Lulu yesterday got hit hard. I'm not saying you dive right back into it, but these are quality companies in the athletic apparel space. Why would you want to? To me, Under Armour is the modern day version of Reebok, right? If everybody remembers Reebok from the 80s, how they were going to upend Nike. They were kind of like the up and coming second brand to Nike. That's what Under Armour reminds me of, right? If you just kind of think from a brand relevancy standpoint, would you rather, do you want the UA or do you want the swoosh? It's that simple. Sometimes it's that simple. I mean, it's superficial, but it is what it is. And UA is just not the horse I'm betting on. All right, so let's talk about breadth. The picture is mixed, right? Because we still have the divergences across time frames. S&P 500% above their 200-day, fading and diverging. Same with the 50-day, fading and diverging. So we still have the majority, right? The majority is still there, but the divergences are in play. A lot more damage at the 20-day level, which is in my note, not here today on the show. But the advanced decline line is holding the breakout level, so that's encouraging. So again, like I said, bent, not broken, and I think we're at a juncture here in the equity market, and that's okay. It's okay to sometimes sit back and say, things could go either way. I'm just going to watch, right? You've had your positions. You've probably had a good run. You've had your risk management process in place. If you've been taken out of names, you might be itching, right? And a day like yesterday, you get a little bit of a pop, and you're itching to put that money back to work. But you know what? It's okay to sit back and say, I'm just going to watch how this plays out. You're at an inflection point, as I said yesterday, and you saw the charts earlier of where we are relative to key levels for all three major markets. So I think it makes sense to just kind of, you don't have to always be doing something. Today could be a great day to do research. Right? Do some reading up on those names that are on that screen that I passed along to you. Cyclical sectors, here it is. Look at XLI. These are all relative, by the way. Industrials relative, nice little rounding here. So it's improving. Materials, I've been talking about it for a while. Nice little uptrend here in the near term on a relative basis. Contrast that with the financials and energy, the bottom two. I mean, clear downtrends. Down into the right are not the types of charts you want to own. So you can see it's not just dive into cyclicals. Well, what parts of cyclicals? Let's favor industrials and materials over financials and energy. And then we'll leave it with the dollar likely resuming its downtrend. That's going to wrap us up for today. I hope everybody has a great Thursday. I'm back with you tomorrow.